the analysis average payoff win versus loss trade, we measure your average trading performance either in pips or percentage for your winning trades and your loss trades. The average return from a winning trade and a loss trade says quite a bit about the trader, the strategy, and the ability to let winning trades run and cut losing trades early. Many strategies in trading are fundamentally based on achieving a multiple in profit compared to amount the trader is willing to lose with a trade. And this is exactly what this analysis output reveals. You may have heard about the return-risk ratio in trading already. For example, a return-risk ratio of 2 would describe that your performance in a winning trade is twice as big as your loss in a lost trade. Dividing your average return in a winning trade from this analysis by your average loss in a lost trade gives your own personal return-risk ratio based on your actual trades. When screaming for trade setup, you may already have a defined return-risk ratio in mind. You seek for trades in which the potential gain is twice as big as the potential loss, for example. However, even if you enter only trades with a return-risk ratio of 2, your actual trading result may show a much lower value. This is due to the fact that many traders struggle to let their winning trades run. Your take profit level may be at 2 times of your stop loss level, but it may be that you close a winning trade early or adjust the stop loss further away, both impacting the return-risk ratio of your trade. Now, the average trading strategy is aiming for an average return that is larger than an average loss. Some trading strategies seek many small gains while only incurring very few losses. A strategy in which the return-risk ratio is only 0.2 can be highly profitable if the percentage of winning trades is 90%. At the same time, a strategy in which the return-risk ratio is 2, however 75% of the trades are lost trades, will end up with a negative result. Nevertheless, the ability to let your winning trades grow is crucial for many strategies to result in a profit. Just too often we see strategies in which the return-risk ratio is sitting between 0.5 to 0.8. However, only 50% of the trades or less are actual winning trades. Talking to those traders, it is very often that their initial trading setup was aiming for a return-risk ratio above 1, however, they were not able to constantly stick to their self-set target. For many traders, it is much tougher to achieve an actual return-risk ratio above 1 than achieving a hit ratio of above 50%. Meaning that more than 50% of the trades end up with a positive result. Traders rather settle with a small profit than having the risk of the trade ending up in loss again. Moreover, many lost trades in the raw are hard to emotionally digest, oftentimes leading to irrational decision-making as outlined in many of the other videos. However, if a trader could just in 1 out of 5 trades ride the momentum of the trade and make a nice profit of 50 pips with a 10 pip stop loss, the trader would make a really nice profit already. However, traders need to learn to deal with many lost trades in a row and keep making rational decisions. Enough with the theory, let's now take a look at the output chart. The chart shows the average profit in your winning trades in the one bar and the average loss of your lost trades in the other bar. You are able to check both the average pips as well as the average return. In order to calculate your personal actual return-risk ratio, you can just divide the average return in winning trades by the average in lost trades. For this trader, the return-risk ratio is 6.4 divided by 4.6 equals 1.39. Additionally, in the line chart, you see the average benchmark performance. Profitable traders with a similar trading style to yours are combined in this benchmark. If you are actively working on your return-risk ratio, you may also want to check the more recent time frames of the chart, such as the 3-month view. The analysis is very well suited to reveal certain issues in the anticipated return-risk ratio and the actual return-risk ratio as described beforehand. Moreover, it is a great tool to track your improvement or try different strategy in single accounts. Most of the time, seeing the analysis in combination with other analytics is most powerful. The percentage of trade with a profit, your performance if you adjust your stop loss throughout the trade, your performance if you stop a winning trade early, and also the analysis on performance if you place your take profits further away all complement this analysis. For example, if you see that your performance would be better in case you would have stick with your original trade setup when manually stopped your trade in profit, and you also see that you currently have a return risk ratio of 0.8 with 50% of the trade being profitable, you might very well have the chance to become profitable by working on your ability to let winning trades run. One final watch out I would like to note, sometimes we see extreme trades that can have the influence on the average performance. An extreme loss trade through averaging down or increased risk after many loss trade might result in a significantly higher negative result for your average loss trades. In case you have such extreme loss trades or winning trades, you might want to eliminate those trades for your consideration or look for time frames which exclude those trades. Moreover, you may also choose to receive alerts from Hoc-trade in case a current position has a worse return risk ratio compared to your previous average. The return risk ratio of an open position is calculated based on your take profit and stop loss for this trade. Trading can be very demanding, and a little technical support may actually help to free your mind and focus better.